Warahmatullahi wabarakatuh. Good morning.
We are from group 2 and we will to explain about accounting basic. But before that, we want to introduce ourselves. My name is Zefanya.
My name is Andhea Puspita.
My name is Windi Nur Cahyani. And here we go to explain of the material.
Understanding accounting according to expert of the money definition and understanding of accounting represent different things. This difference occurs because the experts explore different lists of sins. Here are some definitions of accounting according to some experts. 1. According to Wagan, Kiso, and Kimmel. For them, accounting is a part of an information system that identifies a record and communicates economic incidents in an organization to interested users. 2. Sunyato. From here, accounting is a stage of the process of collecting, identifying, recording, classifying, summarizing, and presenting of reporting many financial transactions and interpreting the result for decision making. 3. Warren et al. In general, accounting is an information system that produces reports to parties who have an economic activity and company condition. 4. Sufatwoto. For him, accounting is a technique for measuring and managing financial transactions and providing management results in the form of information to internal and external parties of the company. External parties are meant to consist of investors, government, creditors, labor union, and others. 5. Sue Marsono. The definition of accounting or accounting according to him is a process of identifying, measuring, and also reporting economic information to enable clear and firm judgment and decision for those who use the information. 6. Munawir. For him, accounting is an art rather than recording, classifying, and summarizing an event which is at least partly financial in nature in a expeditious and direct manner or expert in money, as well as the information arising from it. 7. Paul Grady. Accounting is a body of knowledge and organizational functions that are systematic, authentic, and original in recording, classifying, processing, writing summaries, analyzing, and also interpreting all transactions and financial events and characteristics that occur in the operation of accounting entities with the aim of providing meaningful information. Management is needed as a report and accountability for the trust is received. Winarno. Accounting is a process of recording financial transactions and processing transaction data and presenting information to entitled and interested parties. 9. Bastian and Suharjono. In their book, Committee on Terminology of the American Institute of Certified Public Accountant, Bastian and Suharjono, the notion of accounting is the art of recording, classifying, and summarizing transactions and events of a financial nature in a meaningful way, also in units of money and influencing the result. Accounting definition. 1. Definition by use. Accounting is a service activity that serves to provide quantitative information about economic units, especially financial ones that are useful in decision making. 2. Definition by activity. Accounting is the art of recording, classifying, and summarizing transactions or events which are at least of a financial nature by interpreting the result. From the definition stated above, it can be concluded that accounting is the process of identifying, measuring, and reporting economic information to enable fair and firm assessment and decision making for those who ask the information. History of accounting development. Professor Robert Sterling, an accounting expert from America, divides the development of accounting into their stage. 1. Planning stage. In this stage, the input as is the result of community aspiration carried out by the council and the executive. These aspirations are described in the proposed activities or activities of the respective unions in the relevant government entity, which will be proposed with the solving analysis standard sub so that the proposed activities reflect the performance target and the committee proposed budget, which becomes the priority of the region concerned. The final result of the work unit budget line in the work unit is realized in the REPBD, which is then proposed to get justification by the council as planning output in the form of EPBD. 2. Implementation phase. The input is the output of the planning stage in the form of EPBD. Then in this implementation stage, the process is that the EPBD that has been determined is then implementation using an accounting system that has been adjusted to produce useful information for all parties interested in the implementation of the EPBD by the executive, both in the form of quarterly report and annual report as accountability report to the region. 3. Control phase. The input in the form of a EPBD implementation report is the first as a basis for evaluating the report, which can also be used as an achievement of the accountability of the regional head whose output is in the form of evaluation result and acceptance or rejection of the regional head accountability report. Accounting 5. Financial accounting. Financial accounting is also known as general accounting, which is accounting related to recording company transactions and preparing financial report on a regular basis based on accounting principles. The financial statement can be issued as internal and external information for the company. B. Audit accounting. Audit accounting is an accounting activity related to financial audit or general accounting. Public accounting conduct an examination of the report that support the financial statement by studying the feasibility and reliability of a report. C. Management accounting. The central point in management accounting is information for the parties within the company. Management accounting uses, among others, controlling company activities, monitoring cash flows, and assessing alternatives in decision making. For examples in terms of determining the selling price, spending, production, method, and investment. This field of accounting also deals with specific problems faced by company managers from various organizations level using historical data and interpretive data. D. Cost accounting. Cost accounting is a field of accounting that emphasizes activities on costing and control of costs, especially those related to the cost of producing an item. In addition, one of the main functions of cost accounting is the collection and analysis of data on costs, both past and future, to be used by company leaders as a means of control over the activities that have been carried out, as well as a tool for making plans for the future. E. Tax accounting. The field of tax accounting includes the preparation of tax returns as well as considering the tax consequences of the planned business transaction. P. Budget accounting. Budget accounting is a field of accounting that deals with the preparation of financial plans regarding company activities for a certain period of time in the future, as well as their analysis and control. Goal or benefit of accounting. Accounting objective. The main purpose of accounting is to present economic information from an entity to interested parties. What is meant by entity is a business entity or company or organization that has its own asset. Economic information generated by accounting is useful for parties within the organization itself, internal, and parties outside the organization external. The management is an example of user of information from internal sources. This accounting information is used by management for planning, controlling, and evaluating the business activities carried out. From the set of information used from external parties, it is divided into two, namely, 1. External users who have a direct interest in accounting information, for example, investors and creditors. 2. External users who have no direct interest, such as economic analysts, employers, and government institutions. B. Benefits of accounting. To obtain economic information, company financial information, to profit management accountability to company owners, to know the development of the company from year to year. Types of accounting profession. 1. Public accountant. Public accountants are independent accountants who profit their service on the basis of certain payments. They work independently and generally set up an accounting firm. A public accountant can perform audit, for example, of tax service, management consulting service, and management system preparation service. 2. Internal accountant. Internal accountants are accountants who work in a company or organization, also called corporate accountant. The function that can be achieved rank from ordinary staff to the head of the accounting department of the director of finance. Their duties are to prepare accounting system, financial report for external parties, financial report for company leaders, budget, handle tax matters, and conduct internal audits. 3. Government accountant. Government accountants are accountants who work for government institutions For example, in the Office of the Financial and Development Supervisory Agency (BPKP) and the Financial Supervisory Agency (BPK). 4. Education accountant. Educator accountant are accountants who are in charge of accounting education, conducting accounting research and development, teaching and complementing accounting education curricula in universities.
Okay, I want to explain about accounting fields and types of companies. The accounting field or specialization is divided into several sections, include A. Financial accounting, the field of accounting that deals with the process of accounting, preparing financial statement periodically for an economic unit as a whole. B. Auditing accounting. The field of accounting is related to the examination of financial statements. In the case it concerns the truth of a financial report and the results of conclusion are useful for parties outside the company, such as investors, shareholders, creditors, and the government. C. Management accounting. The field of accounting that deals with solving specific problems faced by company leaders, which include planning, classifying, summarizing, decision-making, organizing, directing, monitoring, and controlling. D. Cost accounting. Cost accounting is the process of recording and presenting the cost of making and selling product or service in current wise and interpreting them. A. Tax accounting. The field of accounting relates to the calculation and preparation of tax returns, as well as everything related to tax matters, such as determining the object of corporate tax. F. Information system. A branch of accounting that deals with planning and performing procedures for collecting and reporting financial data. G. Budgeting accounting. The field of accounting which deals with the preparation of operational data that has been running and a financial statement plan regarding the company's activities for the future in a certain period of time along with its analysis and content. H. Government accounting. The field of accounting that deals with recording and reporting transactions that occur in government agencies. And the next is types of companies. Based on the activities and output produced, companies can be classified into three. One is service company that in carrying out their business only provide service in the form of service to their customer. For example, financial or legal consultant, banking, expedition, and hospital. 2. Trading company. A company whose main activity is to purchase goods and then resell them to their consumers. Example, grocery wholesaler, supermarket, mobile phone 3. Factory, industrial, or manufacturing company. Companies whose activities are processing materials, starting from raw materials, materials in process to become finished materials, then the goods are sold to consumers. For example, car factory, mobile phone factory, and shoe factory. Thank you.
Okay, I continue. I will explain about financial statements starting from the types and elements. Let's start. Financial statements are a record of financial information of a company in an accounting period. The existence of financial statements can be used to describe the company's performance, especially in the financial sector. Types of financial statements. The preparation of financial reports follow the guidelines for financial accounting standards, which determines 5 types of financial statements, namely income statements, balance sheet, change in capitals, cash flows, and notes to financial statements. Income statements. This type of financial report describes the result of the company's operation in a certain period. In the income statement can be seen the amount of income, source of income obtained, the amount of cost, and the type incurred during a certain period. The income statement by present the operating activities carried out by the company for a certain period. This report is used to evaluate the performance that has been achieved by the company and provide an overview of the achievement of cash flows in the future. The income statements can be presented in 2 forms, namely single step and multiple step. Single step, this form doesn't classify income and expense into business groups and outside the business, but only separates revenues and profit with cost and losses. Multiple step mode. Several groupings of revenues and costs are carried out in a certain order. The preparation of profit and loss financial statements is useful for evaluating the company's past performance as a basis for considering the company's performance in the future, as well as assessing the risk of achieving cash flows in the future. Balance sheet. The balance sheet financial statement shows the company's financial position on a certain date. The financial position means the position of the number and type of activities and liabilities of the company. According to Smith and Coulson, the balance sheet is a report at a certain point in time regarding the company's resource, its debts, and ownership claims to the resource. The data contained in the balance sheet is useful for provide a financial database to calculate the company's rate of return, evaluating the company's capital structure, namely assessing the company's liquidity, solvency, and financial flexibility. Statement of change in capital. This report contains the amount and type of capital currently held. The statements of change in capital also explain change in capital and the reason for their occurrence. For companies with limited liability companies, this report is referred to as the statements of change in shareholder equity. The statement of change in the capital is useful for identifying the cause of change in the company's owner's equity in the value of the asset to which it's entitled. Cash flow statement. This type shows the company's cash inflows and outflows. Cash inflows are in the form of income or loans from other parties, while cash outflows are costs that have been incurred by the company in a certain period. A cash flow statement is also known as a statement of source and use of funds. According to Lorent, the cash flow statement is a summary of cash received and payments from a company within a certain period of time. In its presentation, cash flow statements are divided into three groups, namely operating, investing, and financing. Operating includes all activities and transactions that are included in the company's investment or financing activities. Cash flows from operational activities include cash flows from production, distribution, and service provision activities. Investing include the purchase and collection of receivables, return of merchandise inventory, loan payments, procurement and sales of company equity and assets, and so on. Financing includes obtaining a resource from the owner and providing returns on investment that have been made, borrowing and repaying debts by the owner or vice versa. Notes to financial statements are additional notes or information added to the end of financial statements. It aims to provide additional information to the reader. Another function of the notes to the financial statements is to help explain the calculation of certain items in the financial statements so that they can provide a comprehensive value to the financial condition of a company. Not only that, through this record, the company can provide information about accounts payables, going concern, continuing liabilities, and other contextual information. Elements of financial statements. Financial statements have 7 elements, including asset, liabilities, equity, income, expense, gains, and losses. Assets. Assets are what a company owns and expects to generate in the future. In this case, the asset can take various forms. For example, soil, building, property, computer equipment, capital in the bank, cash in the company, advance from order by client, inventory, receivable, and other assets that meet the criteria. Liability. Liabilities are companies' obligations. This obligation is also expected to generate and provide positive economic benefits for the company. Some examples of liabilities are bank loan, bank interest, tax, intercompany debt, salary debt, and many more. Equity. Simply put, equity is the value of asset minus the cost of liabilities. Some examples are dividends payments and share capital. The increase or decrease in equity depends on the movement of assets and liabilities. Income. Revenue is included in one of the basic elements of financial statements. The company's income can be in the form of sales result from the business activities that sell goods or services or outside the main activity of a business. Outside of the business activities, income can be obtained from bank deposits and dividends obtained from equity investment. Expenditure or expenses. Company expenses can be in the form of operational or administrative expenses. From example of financial statement elements that are included in expense are as follows: goods production costs, wage, transportation, promotion, rental expense, the cost of repairing and maintaining company's assets, electricity, internet, and telephone bills. Next is case profit. Profits are obtained by increasing the equity of a person or a company. The profit amount may differ from one period to another. If the current value of an asset is higher than when you bought it, then the profit value is the difference between the current value of the asset and the cost of buying the asset. For the loss, it is the opposite of profit. Losses occur when the purchase value of an asset in the past is greater than the value of the asset in the present, which can also indicate a decrease in the value of an asset. Meanwhile, from the other side, losses can also mean the excess value of expenses compared to income earned within a certain time span. Financial report function. Investors and financial analysts rely on financial data to analyze a company's performance and make predictions about the future direction of a company's stock price. One of the most important sources of reliable and audited financial data is the annual report, which contains the company's financial statements. Financial reports are used by investors, market analysts, and creditors to evaluate a company's financial health and earning potential. The three main financial statements are the balance sheets, income statements, and cash flow statements. Conclusion. Financial reports can be analogous to a report card for your business. It contains all data related to business finance as a whole, so that you can know the financial health of your business well. All of these reports can also make a more mature business plan, because you can improve based on the factual data in the report. Keep in mind that the objective of financial statements is to provide information about an entity's financial positions, financial performance, and cash flow that is useful to most users of financial statements in making economic decisions. Learning accounting does have to take it slowly. At first it looks difficult, but if it is understood well, surely you will learn it easily and will like it. I hope you understand some of material that I convey, and that's all from me. Thank you so much for your great attentions. I would like to apologize if there is a mistake.
That's all for our presentation today, and thank you for watching. Wassalamualaikum warahmatullahi wabarakatuh. Bye.